Something we've talked about on this channel for the better part of 2 years is something called the spread. Now, in this example, I am not talking about peanut butter or jelly or anything like that. I am talking about the spread between the 10-year note and the 30-year mortgage. Now, historically speaking, if you zoom out, this spread is averaged, depending on who you talk to, between 175 and 185 basis points. During the pandemic and the fact that the Fed broke housing, it did expand to 307 basis points. We're going to talk about where it's at now. We're going to talk about perhaps where it's going, but most importantly, why this is important. And we're going to do this with Ulysses. How you doing, buddy?
I'm doing well. Thanks for having me back.
Oh man, I love our conversations. You know, we don't look at the world the same way, which means two people can talk and disagree but be respectful. So I think that
100%.
is what needs to happen today. I wish we had more people who didn't disagree talk and communicate. But you did do a report recently about mortgage spreads, which had my attention because this is something I've been highlighting as a huge reason why rates were so high, even though
Yeah.
the 10-year was so low. So do me a favor, introduce yourself to the audience one more time, and then let's get into the data that you pulled together.
Yeah, you got it. So my name is Ulysses Awesome. I am a contractor and consultant, and I'm also the real estate analyst for Macro Edge Research. This weekend, actually tonight, coming out through Macro Edge Ozone is going to be a report on real estate and the mortgage rate spread between a 30-year average mortgage rate and 10-year treasury.
Yeah. And again, folks, we're going to talk about where where it's been, but probably more importantly, where it's going, and of course, why it's important. If you watched my daily financial news this morning on Sunday, October 6th, you realize that mortgage rates took a huge, gigantic move on Friday. They were up 27 basis points, now over 6.5 after that jobs number. But let's talk about what's going on today with the spreads, Ulysses. What do you got? Let's show some pretty charts.
Sure. Well, I'm going to throw up a chart here that just shows the mortgage rate spreads going back to, I believe it's 1974. And this is going to show that spread along with new home construction. And what I want this to show is to highlight when the mortgage spreads compress, when that's something that's signaling positive for the economy overall. So let's go ahead and share the falling rates as they are a bullish event. And let me know if that comes through okay.
Yep, it has. Thank you very much.
Perfect. So when mortgage spreads decrease, meaning lenders are willing to lend at a reduced spread over the 10-year treasury rate, when that falls into rising construction and new home residential construction, when sales are increasing and when unemployment is decreasing, traditionally, that has been a signal of either exiting recession or restarting of the business cycle, as you will.
Right.
And as you note, each one of these green bars is one of those rate spread drop cycles into increasing home building sales. You can note the home building is the dotted lines here, and the black line is the actual mortgage spread over time. So it does move. Lenders obviously will increase their spread or decrease their spread according to business situations.
Yeah, let's talk about the spread because I've talked about it a lot, but I don't really think I've ever had a detailed conversation with why a spread would expand or reduce. I think that warrants a discussion. I think the average consumer probably doesn't even understand the spread, even though we kind of feed them. But let's talk about why mortgage spreads would expand or decrease. Do you have any thoughts on that first? Kind of what's going on?
Yeah, I think traditionally, when there are signs of credit impairment or credit distress, then you would want to create a bigger spread, right? You would want to have more revenue on top of what you would on a treasury. And I believe that historically throughout looking at recessions, we see that there's an increase in the mortgage rate spread. And that's usually a sign of distress. When you don't see that risk anymore, you're willing to take a lower spread between the 10-year treasury on lending because things are going okay. Business is growing, so you don't need to have that large spread between the two,
Mm.
because volume is picking up again. It's an expansion of the credit cycle.
Yeah, when I look at the spread, I kind of break it down really simply. I think the word you used was risk, and I think that's the right one. Really, for me, it's appetite. Does
Sure.
the bank, aka the lending institutions, do they have an appetite to lend or they don't? Because I've been doing this for 25 years. I have been in cycles where banks frankly told me, no, we don't lend to investors. You're the devil. They
Oh,
said
sure.
things like that in 8, 9, and 10. But really what it is to me is, does the bank want to grow or is it concerned about something, right? Whether it's
Yeah,
defaults
absolutely.
or cycle.
I,
So when they're falling, to me, that really points to, you're right, it could be the end of a cycle or an expansion, but really it to me, lowering the spread is it's the sign that the system is working, because the only thing you could do as a lender at some point is lower rates to generate business.
agreed.
Yeah. So I
Agreed.
think
I
that's
think you can't remove the psychological or
mhm.
sociological components out of it.
Yeah,
And you described that really well. Does the bank want to grow, or do they have
exactly.
concerns as well about growing that part of their business?
Yeah, and then to your point, in some of these charts, there's a second order effect for people who need money, aka builders, right? Very few builders
Right.
build with cash; they build with debt. Um, it's the second order effect is it going to become profitable to do these are 6, 9, 12, sometimes multi-year projects, and it's all about the cost of capital to them.
Yeah,
So it
absolutely.
makes sense as that spread comes in, builders come back. So that logically makes sense to me, I think.
Yeah, great points there. Uh, I like to look at the economy through home building because it's an industry that I have worked in extensively and I
Hmm.
understand really well. And so when I, analyze it in this fashion, it's easy for me to see where things improve or where things are declining. We talked before about recession, and
Sure.
uh, so one of the things I'm going to change from sharing here
Hmm.
is uh, instead of sharing this situation where it's bullish, I'm going to
Hmm.
share the situation where it's, basically a recessionary signal.
Sure.
And that is very similar chart.
Got it.
We'll boost this up a little bit. Is that better?
Yep.
Okay.
Perfect.
So this is also, and you notice the red bars are where uh, rate spreads have compressed, only to be followed by increasing it again. It's almost like uh, false signal of dropping rates. And as you notice, at the end of last year, we have one
Mhm.
of these red bars. We had rates dropping. Well,
Interesting.
similar things happened prior to each recession. We had a drop, but that
Hmm.
drop was into decreasing sales of new homes and
Hmm.
rising unemployment. So if you're the way I look at this is if the spread is decompressing while economic situation is deteriorating,
Hmm.
that's a sign of recession or going into recession. Now,
Okay.
it was also accurate in 2020 here, but it was
Yeah.
a sudden change that I don't think it's worth
Yeah.
saying.
We don't need to talk about 2020. That was
Yeah, right. There
yeah,
were so
just
many things that happened that were out of the ordinary that
yeah,
it's kind of useless.
yeah, that's a data point that we both can agree. We could skip
Yeah,
2020.
right, right. We just
That's
skip over that, and
yeah.
that was something else.
So let me play with this a little bit. So the
Yeah,
point here is, again, the red bars versus the green bars is kind of like, hey, do we have a signal, basically signal that there's pain ahead?
correct,
So
correct.
the red bar basically saying, hey, rates went down, or the spread, I shouldn't even say rates, the spread
Correct.
went
The
down a
spread,
little bit, but then expanded quite quickly, it looks like.
correct.
But it also has unemployment. Which one's unemployment? That's the dotted line, right? The red
Yep. So
dotted
that's
line.
unemployment is the red line,
Okay,
and then these
got it.
again is the new home sales, um,
Hmm,
and that
sure.
is the percent change from a year ago, right? And
Yeah,
so the reason why I use that is because you can clearly see it declining or
yeah,
expanding very rapidly out of
yeah. I
recession as
like
well.
that. I like that year on year. And again, the one thing that's really important about this is, I don't know if people realize this, but if you want to just pick one kind of job or industry, to signal recession or not, to me, it would be single family home construction,
Sure.
right? I think that is a very important part of the economy. It's something you could zoom in on and watch, is employment growing or shrinking? Now, I don't remember
Mhm.
what Friday's number was around construction, but I'm going to guess it was positive. So I think the only thing that was negative was manufacturing. But,
Correct. Uh,
but what is going on with construction employment?
sure. So construction employment is currently, according to both labor surveys, is holding up quite well, considering the lack of construction. I shouldn't say lack of construction, the decrease in construction we've had since 2022. We're
Oh,
at
sure.
basically
Yeah,
25% less homes under construction than we had in 2022. And now we've
interesting.
seen multifamily contracting as well. We've gone from over 1 million units to 800,000 units under
And getting
construction.
worse, I guess, I would think.
Correct.
Yeah.
Correct.
Now, am I right, Ulysses, that single family construction employment is significantly larger than multifamily? Do I have that fact correctly? Like when you just total the employment of
Yeah, so
singles
they
versus
actually
multi?
fall under the same category in that regard.
Yeah,
So single family, multifamily both get considered as residential construction as far as
right.
employment goes.
Yeah.
Yeah.
Do you know by chance roughly, or if you were to guess, would it be like 70-30 when you were going to total 60-40, 50-50? Any idea what just a ballpark for the audience?
I don't, but
Yeah,
they
I think
basically
we need
break
to
that
figure that
down.
out.
It's
Yeah,
all considered residential, and they break it out. Are they carpenters? Are they
right.
construction management components? So they don't really
Mm,
classify it as multifamily, single family. There are definitely businesses in out there that they don't operate in both spaces,
sure.
but a lot
Yeah.
of, at least in the carpentry world, a lot of the same carpentry companies,
Yeah,
they do
they
both.
go back and forth. Yeah,
Right.
makes sense. The reason that's important to me is I think we're on a historic collapse in multifamily. I'm talking the big stuff, apartments, specifically in the Sun Belt. When I look at the units coming, we already went from 1 million to 800. We're going to go lower there. But as I look out into 2025 and 2026, I suspect, again, all this could change in a moment, but I think we're going to be shocked that single family construction picks back up. And I don't know if we had this conversation, we probably did, but I think this quote unquote recession we're in is
Hmm.
going to be very different than all the ones I've studied, because I
Sure.
think it's going to be called a rolling recession. And I think real estate, specifically mortgage, I think mortgage is a great example. Now, Friday could blow this all up. We'll see. But the mortgage industry is down like 60% as far as
Yeah.
headcount.
Right.
But what we've seen the last 4 to 6 weeks is a refi boom, right? They're, up triple digits year on year. Again, a small number, so it is what
Hmm.
it is, but up nonetheless. I think there's a chance. I talked to two mortgage guys on Thursday, and both of them are looking at hiring people. Now that was Thursday before Friday
Sure.
happened, so who knows? But it's funny to think about that mortgage could actually help pull us out, right? Because it's going to come back and start growing to be a positive contributor to
Yeah.
GDP. I have all these concerns about bad refis. It just freaks me out that mom and dad are going to refi 2% mortgages into 7% mortgages, but
Sure.
we'll see. Yeah. So it's funny to think about what might happen in the single family construction. I think people are going to be shocked that it grows, especially if the spread to this point of the conversation, if spreads come in. Now,
Mm-hmm.
again, they blew up on Friday, but I think we're on a trend where spreads come in. What do you think?
I think that we have been on that trend for the last 12 months where spreads are reducing,
Mm,
but
yeah,
I think if uh, the economy deteriorates any further,
yeah.
we're going to see the spreads, go back up.
Yeah, let's play with that a little bit because again, neither one of us has the crystal ball. We're looking at the data and making,
Right.
we're talking about the future, which is always fun. One of the things that I look at, and I think this will be either a point of agreement or disagreement. This could be where it all starts. Do you think the Fed's in a rate cutting, has the rate cutting cycle started, or do you think the jobs number on Friday put them on pause? What do you think?
No, I think it started. I think Powell has even addressed that and his concern about the revisions that have already occurred and that
Yeah,
he believes they're going to be
818. That's a big number.
right. And then if you look at um, revisions that were made, past the headline employment, uh, there was another revision downward. And then we had 900,000 new government jobs in
Yeah.
September.
It's a dirty number. Yeah.
Uh, and then one of the things that we haven't even seen is the effect of Hurricane Helene on unemployment.
Yeah.
That's going to be coming out later. So,
Yeah. I said that too. Yeah.
I don't know what that number is going to be, but I definitely
Well,
think that's going
we
to have
had
an
that
impact
little
on employment.
Texas hurricane, or was that 3 months ago? And it
Yeah,
bumped unemployment up a tenth.
yeah. Well,
So Colleen's
yeah.
much bigger.
And I think that that was probably overstated as far as the impact there. So
Mm,
this one, I mean, we're talking about it's affected parts of Florida, parts of Georgia,
big
Tennessee,
geography.
North
Yeah.
Carolina. So who knows what that impact is going to be? But I see there's more softness in the labor market, at least right now. And then,
Yeah.
of course, we've got earnings season coming up again in
Yeah.
October.
Yep.
And that's one
Yeah.
thing that MacroEdge has been great at is tracking layoffs
Hmm.
and making sure that all those
Yeah.
layoffs are counted and
Let's talk
tracked
about September, right? Wasn't this last September the largest amount of layoff announced in several decades?
from Challenger. Yeah,
Oh
Challenger
yeah,
Gray
Challenger,
Christmas.
Gray
Yep.
Christmas. Yeah,
They
yeah.
said it was the largest, and I don't remember the time frame, but it's been a long time
Long time, long time.
that they tracked. It's actually been reduced from what we're tracking over the
Hmm.
prior couple of months. We had tracked more, but we track some different sources than Challenger does.
Hmm.
And that's not to
No.
Challenger Gray's Christmas is wonderful, so that's
Oh yeah.
not a
Not a
negative
dig.
at all.
Yeah, right.
No,
Not a dig. Yeah, yeah.
just that MacroEdge tracks different
Different thing.
sources.
Yeah.
So we saw a decrease in September from the prior couple months, but
Oh,
but we do see that it's going to probably pick up again in October and November. So
yeah. It's going to be wild. Again, it's one of the things that my channel and my social media blew up on Friday. It's really funny. Either you're declaring soft landing or you're saying the government's lying,
yeah,
manufacturer, blah blah. I mean, it's like so polar. And you know what? I don't even play that game. I'm like,
yeah,
I'm like, I don't care.
right.
What actually happened? Like,
Yes.
what actually happened?
What are the
Well,
facts? What's the
yeah,
reality?
debt got more expensive. That's what happened on Friday. The
Yeah,
10-year
100%.
bond went up 11 or 12 basis points. Mortgage went up 27. Folks,
Yeah,
that's like 3 or 4 standard deviations
yeah. Treasuries
normal.
across the board were up. Like
Yeah,
every
every
from
duration.
one month to 30 year, we're all up.
Yeah, so that's the important thing, right? Don't get distracted by the noise around the data. Look at reality. The
Right.
reality is debt got more expensive on Friday. All debt got more
Yeah,
expensive. That's
absolutely.
that's that's real. Now, like we talked about earlier, more expensive debt could impact housing in a big way. We just
Oh,
talked about
absolutely.
construction, right? Construction debt more expensive. I've been talking about a refi boom. Is that over? Dude, a 27 basis point move that could impact refis. I mean, that's
Yeah,
gigantic.
absolutely. Especially talking about the dollar values of just take like the median price of a home.
Yeah.
Uh, 1/4% can make an enormous difference in somebody's monthly payment there.
Oh, hundreds of dollars.
Yeah.
Hundreds. Yeah. Yeah. I will say that the move was so violent and kind of 3 or 4 standard deviations from the norm. You again, my words, not yours. It almost
Sure.
has to have a pullback Monday and Tuesday. That was so large. I can't imagine it stays that. Now again, it could trend higher. It's just that move was so violent. It like
Yeah.
stands out on a chart. It has
Well,
to
I
come
think
in, I think, the first part of the week.
it might be a little bit longer. I
Hmm.
guess that's part of where I'm seeing uh, in that chart where it's not a bullish spread.
Oh
I
yeah.
think that's where the spread is starting to increase again because of um,
What is the spread currently? Is it like 275 or 265 or something like
I
that?
think it was 265 as of
Yeah, 265.
Friday.
Yeah, so that's something we need to be watching. Again, we've come down from I think 307 at the peak of this cycle or 308, something
Correct.
like that.
And
Um,
that's one of
yeah.
the things that I think I have concerns about, and we've shared and discussed a little bit of future
Hmm?
rates coming down, but is if we're going to expand the spread from where it's already at,
Yeah.
and the spread's already still high compared to where it has been, uh, you know, as
Mhm.
an average over 50 years. So if the
Sure.
spread expands more, then that's going to
Yeah. So
then
let's
there's
play with that.
more
Let's
pain
play.
in
Oh
the
yeah, for
near
sure.
term, for everybody in the sector. I think you're
It,
right about eventually when the mortgage does come back, that's going to be a leading indicator when
mhm.
coming out of recession. And to your point about rolling recession, I think it'd be hard pressed for anybody to say that the mortgage industry or real estate industry hasn't been
Oh,
facing their own recession.
oh,
Uh, you
depression
know,
levels.
right. You're right. Even though we're not showing the Enber having declared a recession. Certainly those industries are.
Oh
Uh,
yeah, there's no
and probably
question.
when it does to get declared, they'll be on the front side
It'll
of,
be outside of it,
yeah, they'll
exactly.
be guys, you're late to the party. We're not in recession anymore. Everybody else is.
Yeah, no, it's really hard for economists. And again, I've studied it for 30 plus years. A rolling recession is not traditional, right? We all want it to be the great financial crisis. We all want it to be the dot-com kind of Wile E. Coyote off a cliff and falling.
Yeah,
So this is going to be wild. I think when it's all said and done, we're going to be in a 2 year rolling recession, and we
sure.
may not have those negative GDPs, right? You'll be below trend, but it's wild. So let's play with this mortgage spread because this is wild to me. This is so important. Are we entering or exiting? Because I think you're right. Is it going to be a green bar or a red bar to go back to our two charts?
Right.
Um, so we are in a rate cutting cycle. I think we both agree on that. Powell said they're coming. It may come slower and
Right.
less of them. But I think the next move is down, not up. I think we both
Right.
can agree with that.
Absolutely.
Um, Actually, you know what? Let me ask you this. I'm actually starting to think there'll be no more rate cuts this year. What do you think of that crazy idea?
That's certainly possible. It they might not. Maybe
Yeah,
if whatever they're looking at, if they're seeing that there isn't more softening of the labor market, they won't. Um,
yeah.
I,
CPI
I
comes
think
out
that,
Thursday, right?
yes, yep,
Any thoughts on that? Because I think I saw the expectations. It was 2.5. This is headline, not core headline.
right.
Last month was 2.5. It's expected to fall to 2.3
I think
headline.
that's the expectation. Yeah, I
Yeah.
think we're probably going to be somewhere
Yeah.
in that 2.3, 2.5 range.
It's wild, right? Unemployment falls, inflation falling, GDP's at 3% or 2.9 or whatever GDP
Yeah,
now is saying, and we're cutting rates. It's pretty wild to think about.
it is. I've got another chart if you want that
Yeah.
maybe shows what I think the Fed is looking at
Oh,
in
please.
their idea of softness. So I'm
Okay.
gonna share this real quick. And this is again, it's the unemployment rate. Uh move back out. Can you see that okay?
I can. Yep.
Okay.
Year on year. Yep.
Yep. So unemployment, if you're talking about how it changes, right? Again,
Hmm.
if you look at it from a year over year change, it's very rare that it increases, right?
Hmm. Yep.
We have the stretches in between recessions where it's falling. And the only time it's
Hmm.
increasing is when economic situation is deteriorating.
Yep.
Again, we're here, right? We're at 8% year over year increase. Every other time that we've hit 8% year over year increase has been in a recession. We had one exception where we had 3 months in 1967 where
Mm.
that happened, and when we had 1 month in 1953 um, that
Okay.
happened. Every other time that's happened, and again, discounting 2020 because that was an
Yeah.
entirely different subset, but every time that that's happened, we've had a recession. And again, the vertical red bars show those times where the first time that we hit 8%,
Got it.
and that goes back September of last year, we hit 8% year over year, and it's only grown every single month since.
Yeah.
And
Again, I don't know the underlying data of this, but is this just the law of small numbers? Right? Because I think we started this cycle, what, at 3.4 was the cycle low for unemployment?
I think it was even lower than that. I'd have to
Oh
double
my
check,
gosh.
but I
Yeah,
think it
so
was like 2.8, 2.9.
oh my gosh.
Yeah.
I
And
didn't recall it ever
that's
having
where
a two on it.
you heard people saying record low unemployment
Mm,
for so long. That's changing. And now we're
mhm.
getting back to uh,
Where do you think full employment is? Do you have any thoughts on what a full employment, like a balanced economy is? Is it I hear economists talk, it used to be 6, now it's 5%. Do you think it's even lower than that?
I think traditionally it's been 4% is a signal that we're going in the wrong direction,
Okay,
and it grows from there. So it will
sure.
trend back down to around 4, and then it increases again. Uh,
Mm,
so probably, but of course, demographics are changing there as well. So,
yeah, true.
um,
Yeah,
we've got a lot of people that are aging out of the workforce, and not quite as
yeah,
many people as we have going into it.
yeah,
So that might change. Maybe 5% is going to be more normal in the future, maybe 6%.
yeah.
Uh,
Yeah, I don't think it'll be
It's
six. I think
hard to
it'll,
tell.
yeah. And again, these are all, these are all things economists, teachers teach green economists. It doesn't matter in real life, but
Right.
I don't, when the Fed, what the craziest number that I saw in their SOP, right? Their forecast for the future.
Hmm.
It was their call for unemployment to go to 4.4 and then magically stay there.
I
I
saw
I
that as well.
fell out of my chair and laughed. I mean,
Yeah.
that's not what happens to unemployment, right? It
Right. It
doesn't
doesn't
just
just
stay
stay there.
flat.
Yeah.
No.
And that's sort of, I mean, that's the chart I showed, right? Because
Yeah.
really, unemployment is in recession, it goes up.
Okay.
Unemployment goes up.
Okay.
And then when it's not a recession, it keeps going down until recession again. I mean, let's literally a
That's the
sign of a
business
business
cycle.
cycle. Like
Yeah.
we're expanding and more people are getting jobs, or we're
Yeah.
contracting and more people are losing jobs. That's
Yeah.
staying
Let's
at
talk.
4.4 is
That's that's
lunacy.
that's crazy.
Yeah.
It's just crazy. But it doesn't happen like that. It doesn't just hit some floor or ceiling and not move for 18 months. I
Yeah,
mean,
exactly.
that was wild. I was like, you guys, what are you smoking? Um, but when I think about the job market, one of the things I've just started asking myself is because of technology, because of work from home, because of all of these things that are structurally different now
Mhm.
than 10 or 20 years ago, has the employment market fundamentally changed? And what I mean by that is, are we just going to have more part-time jobs in the future than full-time jobs, right? I think I saw the number Friday, full-time jobs are down 500,000
Yeah.
year on year, but part-time jobs are up, you know, bigger than that.
Yeah.
And I just wonder if there's something structurally changing in the job market that most economists are missing. The
Yeah.
whole gold watch 40-year thing is dead and gone. What do you think?
I tend to agree with you on that, actually. I think that we have seen the job market structurally change. I think that's one of the things that is the evolving part of, connectivity, the internet. There's a lot of jobs that people are doing freelance and remote, and that has
Yeah,
grown tremendously since pre-2010,
for sure.
in ways that, they just didn't exist then.
Yeah.
Um, there's not a need to be at certain offices. There's more people that can do it individually as their own
Mhm.
small business.
Solopreneur, if you will. Yep.
Correct. And
Yeah.
then the advent of the gig economy. And I think
Yeah.
that's an enormous part of why we haven't had larger unemployment increases, and why what
I
might be
agree.
different this time around, we might not see, 10% unemployment, even though maybe we have 10% like real lack of
Hmm.
full-time jobs, but it's because people are doing things like door dashing, doing
Yep.
things like Fiverr, and because
Yeah.
that's the other thing. There's blue collar and white collar work, if you want to put it
Yeah,
that
for
way.
sure.
That's
Yeah.
remote and that's app based. So I don't know that a lot of economists do take that into consideration when they're talking about the employment market, but I think it'd be possible to argue it hasn't structurally changed.
Yeah, because I want to pull on that string a little bit because again, if we're early to, if we're in the middle of something and the traditional economists don't see it, but the job market 5 years from now continues on this trend,
Hmm.
we'll simply have less full-time employment, but it's possible. I'm not saying likely, but it's possible. The economy is stronger and growing because we have more solopreneurs and maybe you do two part-time jobs plus some 1099s. That doesn't have to be a bad thing. It might be a really good thing.
Yeah, I agree with that. I don't think it's a sign that it's bad. I think there's opportunities there,
Mhm.
and we talked about this before. I think the more small businesses there are, the better
Oh,
off the country
totally
is.
agree. Like
And that's not a dig
1000%.
at corporate America. That's not a dig at big businesses. this country was the entire tax code is founded on being an entrepreneur, and
Yes,
that's one of the things.
thank you. The tax code is not a penalty system. It's a
Correct,
reward system.
correct. And one of the things that this gets thrown about a lot, right? Inequality or
Mhm,
uh, people getting left behind. Well, the
mhm.
more employees there are, the more people aren't going to see the benefit of the tax code.
Correct.
And
Yeah.
that's by design. And it's not by design to be a penalty against being an employee. It was designed because that's how the country started. There weren't several
It's
giant
how it
companies.
grows.
That's right. That's right.
Yeah.
And so, I think there's potential growth in there for their more small businesses and people
Mm.
seeing um, more of the money that they bring in rather than they
Yeah.
have
I
employees.
mean,
So
simply said, right? I was, my first job out of school was an accountant for a Fortune 500 company. And there are things that you can decide as a business owner to take something from below the line to above the line. And if you don't
yeah,
know what that is, go look it up because that's a really good thing,
right,
right?
right,
If they pay for it before taxes versus after taxes, really good thing. So
correct.
couldn't agree more. I really do think, just having this conversation is so much fun because I do think I'll just call it the jobs market or the employment market. I think it's going through a structural shift. And of course, anytime you go through structural shift or growth or change, it's uncomfortable. There are people hurt by it.
Yeah,
But on the other side of that, pain is perhaps a newer, better, expanding economy, frankly,
right.
because small business growth.
Yeah, absolutely. I think that's one of the hallmarks of recession or the business cycle that gets ignored as well. The there's the recession, right? Receding, but what comes out,
Yeah.
we've often had improvement from.
Oh, for sure. I think that's really well said. And obviously we have a technology today just generally called AI. I think AI, once it's understood, it could be one of those enablers for the solopreneur, right? You can do more as a one man or one woman show today and certainly in the years to come than you ever could before, right? You could spin up a website very
Yeah,
simply these days. You can record a video like this, throw it in some AI and have it chopped up into multiple segments, and now you're a content creator.
sure.
There's so many things I think coming that will help promote solopreneurs and things of that nature. This is so much fun. Let's go back to the spread because I think that's where
Yeah.
we started. I guess the big question, right? You showed two charts,
Mhm.
green coming out, red going in. When you look at your crystal ball and you kind of think about 2025, you have any early opinions on where we might be in this cycle?
Yeah. I think there's a good chance we're in the middle of recession.
Hmm.
Um, I think that we probably, if looking at that spread going back to where it started,
Hmm.
we probably see the spread increase again.
Okay.
Um,
So you think
and
we go back over 300 just to kind of put some numbers people can watch?
yeah, I think there's a good chance we go back up towards 300.
Okay.
Maybe it's not that
Well,
extreme.
yeah,
That
290,
my
whatever. Yeah.
concern it would be, given how high the spread already was
Yeah.
historically, then if that does, if banks really start saying, "Hey, we're concerned about this part of our business,"
Yeah.
then it goes over the 300 that we were at prior, because the
Yeah.
drop that we saw in unemployment was 50 basis points. So if it goes back up over that
Yeah.
then it's more problematic. So I think
Yeah.
we do
Yep.
go back up, but I think maybe at the end of next year we see spreads come back down again.
So kind of summarize that. So again, we'll just put some numbers on it. We're at 265 today. You think the trend's up for the next 12 months, 15 months,
Correct.
uh, which would be recessionary, right? Would be a red bar, right, on the two
Correct.
graphs we looked at. I'll take the other side just for fun.
Yeah.
Um, Again, and it's really because I am banking on a rolling recession.
Right.
That is something I put out there. Nobody else is really talking about it. If I'm right in housing in general, mortgage, real estate fell in and is now coming out,
Hmm.
I think the spread comes in. And again, people can watch this, right? Look at it in November, December,
Yeah,
January,
absolutely.
and we'll know whose opinion was on this. And we'll say 265 today. I'll take the under, you take the over.
Sure.
Um, and I do think it's the residential construction that's going to be, I think when we look back in Q1,
Mhm.
Ulysses, I think that's going to surprise us both.
Sure.
And I think it's going to surprise on the upside. And if I understand your opinion, it's going to surprise on the downside as far as employment goes. Because again, higher cost capital, less construction, less bodies, all
Right.
of that.
Less sales. Yeah. Yeah.
Yeah, the whole thing, right? And
Yep.
it's fun to have this conversation because it could go either way. Um, any kind of closing thoughts on the spread? Oh, dude, it's really wild for the average consumer to look at it, right? Rates were roughly 6.1 before the Fed cut 50 basis points. Now they're over six and
Yeah.
a half. Isn't
I
that
think that,
wild?
yeah, it's fun to see that how off guard that caught a lot of people, news media that
Wild.
reported it differently, and they're going, "Wait, what happened? We just cut rates." Yes, no, no, it's not like that.
Yeah,
And that's the lag that people talk
overnight
about
rate.
with the Fed, right? Like it's a
Yeah,
lag before the effects are felt. Uh,
yeah.
I'll say to
I
your point, if there's two green bars that I think represent what you're talking about on that first chart I shared, and
mhm.
that's 1985 and 1995. And I
Yeah,
would argue those were soft landings that
yeah,
we had.
certainly 94, 95. Yeah, certainly.
The one difference I see there is unemployment wasn't increasing during that time; it was decreasing. But
Mm,
that's possible, and to the viewers. To see that on a chart, that's what I think that chart would show again is
yeah,
its decrease. You'd see that green bar mid-cycle rather than early
yeah.
cycle.
Yeah, again, 94 is the biggest correlation. Again, I think it was a 9 month kind of soft landing. It's the one that, most people talk about.
Right.
Again, I think this one's going to go down like the economics books that are written in a decade. They're going to talk about $1 trillion of M2 collapsing and then expanding. It's like just follow M2. M2 is growing right now, right? It's reversed its negative trend.
Correct. Yep.
Yeah. Sometimes it's really that simple. I do think. And again, we're on a worldwide cutting cycle. Wasn't there like 31 rate cuts last month or something stupid?
Yeah. In fact, only the Bank of Japan has
Really?
been hiking. And I, if you look at the chart of the times when the Bank of Japan increases rates, it's a pretty fascinating correlation to recession as well.
Oh, I
But
haven't looked at that. I'll look that up.
you're right. Everybody else they've entered the cutting cycle. So
Yeah.
uh,
And China, man. Oh, China's
yeah,
not only in the cutting, they're in like give people money, stimmy check time. It's
yeah, they
wild what they're doing
are
there.
they're sort of living out their GFC right now.
That's exactly right. They're living out their GFC. They had
Yeah,
a housing bubble of all housing bubbles. I've
yeah.
seen it. I mean, so my wife's from Taiwan. We've been to
Oh, sure.
China several times, and I was walked by I walked through. I think it was 35. It might have been 38-story building that
Oh,
looked
wow.
finished from the outside. It
Yeah.
was just skin. There was nothing inside. It was like a big shell. It was like wild.
It's it's incredible. Every time I read about it or look into it, it shocks me. It's hard to believe some of the things they've built that have just
Now they're tearing them down,
yeah.
blowing them up.
What else is there to do with it? It's otherwise it's just an empty
Yeah.
structure. It's unbelievable.
It's pretty wild. But when I think about what's going on there, the question I have is when does capital flight, and it's already happening, but when does it double, triple, quadruple, and people find ways to exit capital from China? Because that money has to go somewhere
That's
else.
that's a good question. I think it depends on whether they can, right? I mean, they have a
Yeah,
very different government structure there than we do here.
very different.
Uh,
Yes.
we don't have the type of freedoms, I would argue, for capital. In
Oh, for
fact,
sure.
China has two different currencies for that specific reason,
Hmm.
and regulates it very heavily.
Yeah,
I've
for
seen some
sure.
stuff online where people have the spray painting, turning gold into objects, spray painting it to look like they're something other than gold, and it's real to
Yeah,
smuggle it out of the
yeah,
country. So I don't know if
yeah.
there probably a lot of people doing it already, and
Yeah.
uh,
The question for me is when does it become kind of like approved? Because you're absolutely right. They have capital controls and limits, this, that, the other. But that doesn't mean that they always will, right?
right,
They have a
right.
government structure that could switch on a dime. I'm
I
not
think
saying they
that
will, but they could.
right. Well, you mentioned something there that they're in that sort of hand everybody money phase.
Yeah,
If things don't start stabilizing, who knows what that's going to lead them to change? Because
exactly.
once you enter that type of deflationary cycle, that's really difficult to stop. And it can,
It
we've
can
seen it in
morph
this
into a lot
country.
of bad things. Yes.
Correct. We've seen that in this country a couple times. I don't think deflation is bad in and of itself, but if you enter a period where you're just deflating and that,
It's not, the system is built on inflation. Let's be very, very clear. Deflation
correct.
in a moment, a quarter, couple quarters, totally cool. But you enter a 3, 4, 5 year deflationary spiral, that's
Yeah.
how economies blow up.
Yeah. Absolutely.
Yeah,
Uh,
it's pretty
yeah,
wild.
it's going to be interesting to see what happens from here. That's for sure.
Yeah. Yeah, and I guess the last thing to talk about, we'll just blow it on this. One thing that so again, we both talk real estate a lot. I just put out a video, I think last week, talking about the experts. Now, maybe this has changed because Friday taught them a lesson, who knows? But there were so many people calling for low fives, even a few people
Mm,
brave enough to say we're going to have a four handle
yeah.
on mortgage rates. And I am like, guys, that's not happening. I think mortgage rates will be anchored ±6% all of next year and maybe even longer than that, right? And to put
Sure.
numbers on it, 5.8 to 6.2 is kind of where I see mortgage rates in 2025. And now today they're 6.5, so maybe I have to change my opinion, but I don't think mortgage rates are falling to the floor. What do you think?
I would agree with you, actually. I don't think they are. I can't say, we're never going to get back to that,
No,
but I
be
think
careful what you
people,
wish for. That
you're
would be
right.
bad.
I think people should remember that, the average uh, mortgage rate over the last 50 years, if we just go to the average, it's
Mhm.
7.75%
Yeah, seven
mortgage,
something.
30-year mortgage rate. So if we're below that, it's a pretty
Yeah,
reasonable spot to be at,
yeah,
5, 6%. Sub
I agree with that.
5%, that's, yeah,
I
I
mean,
would
I
agree. I
just,
don't see us getting there unless we go back to
no,
ZIRP policy. And
yeah,
if we do that, then,
yeah.
you
Well,
know,
that's kind of the point of my discussion is if we go sub five, we're in a recession and it's probably nasty.
sure,
So be careful what you wish for. I actually think I just want the housing market to heal
some stability.
and yeah, just stability. And again, if you're a real estate agent, yes, that means we're only going to sell 4 to 4.2 million. We're not going back to 6, 6.5 million existing home sales anytime soon. Uh,
Yeah, I think that's actually a good sign of inflationary overheating, and those are not healthy.
yeah,
It's not healthy to have what we did in 21, 22 as far as uh,
agreed.
sales or price changes, right?
Oh, yeah.
Um,
Yeah, if you
that's
if you zoom out and look at prices, what we had the first 2 or 3 years, what I keep telling people is we got all our appreciation for the decade. If you own an asset,
yeah,
congratulations. Otherwise, it's it's going to be you know
right.
flat flattish. So it's pretty wild to look at. So Ulysses, you do a lot of great work. Thank you for being here. It's always fun to talk to you. Give us your
Likewise.
closing thoughts. Where can we find this article? It'll post tonight. Where do we send it?
Certainly. So you can go to macroedge.net, sign up for Ozone. So you get a 2-week free trial, and then you can read my report this evening on mortgage rate spreads. You can find me on X Twitter at Mr. Awesome, or you can go to uspropertyservices.com, and I got some research that's published there as well.
Yeah, guys, go give him a follow. Again, let me know what you think below. Is mortgage spreads going up from here, going back towards 300? It's currently 265. Or do you think they fall a little bit from here? Because that's really the point. Do we get a green bar or a red bar? Ulysses, you're amazing, man. Thanks again.
Thank you. You have a wonderful day.
You too, man.